They say there are two certainties in life, debt and taxes. The finality of the relationship between the UK and Europe will certainly result in significant tax issues. Much of the discussion to date has been centred around a hard Brexit, or to use the lexicon of the UK government, a clean Brexit. What does this actually mean? Well, so far all we've heard is that hard Brexit is going to result in import-export issues, it's going to result in customs duties, it's going to result in VAT issues. What it essentially means is because the UK will no longer be part of Europe, transfers of goods in and out of the UK will result in them being categorised as imports and exports. That's going to result in tariffs and increased compliance. It's also going to result in goods being held up in customs, and this is going to result in a real business disruption. But there are lots of other tax issues aside from just VAT and customs duties. Looking at things from a direct tax perspective. If, for example, at the moment you have an Irish company which is held by a UK company and it has a sister company which is also an Irish company, the transfer of assets between the two Irish companies would not be liable to capital gains tax. This is on the basis that a capital gains tax group exists. However, as a result of Brexit, this will no longer be possible. The reason being that under the Irish definition of what constitutes a group for capital gains tax purposes, a UK holding company will result in the group no longer existing. The reason being that our definition of a group only applies to EU and EEA member jurisdictions. The way things are playing out in the media at the moment, it does not seem likely that the UK will manage to become an EEA member. So, future asset transfers post-Brexit, assuming this occurs, means that transfer of assets from an Irish company to an Irish company, both of which are members of a UK group, will be subject to capital gains tax at a rate of 33%. There is also a question about existing transfers, because the current legislation that we have provides that the group relationship needs to remain in place for a 10-year period. So assets that have already been transferred, 6, 7, 8, 9 years ago, they're possibly going to be within the scope of capital gains tax. Another issue that we're going to look at is more from the personal tax perspective. So we've already heard and we've seen that there's much talk in the media about there's going to be a lot of movement of people, either into Ireland or out of Ireland, or into the UK or out of the UK. Mobility and the cost association with people mobility needs to be considered. In particular, the question needs to be raised, does a company have a tax equalisation policy? For a lot of organisations which are not familiar with this is going to result in them having to make a decision formally whether they are going to reimburse employees for results in higher tax rates being borne by them or not. So we would recommend that companies look at this now and get their house in order effectively before there is a significant movement of people.